Okay, was today a risk off day or was it a risk on day? The answer to that question is actually yes on both fronts. I'm going to show you how it was both. And the charts are showing us some bullish signs, bullish expectations going forward. I'm going to show you why that is and how bullish we can expect to be. In one area that's been really bullish, we're going to add a trade with today's trade idea to offer some balance of what we've been looking at lately. In that particular area. So let's go ahead and get started. Today is Wednesday, August the 8th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Click that mouse over the Market Outlook, Market Scholars, logo here in the bottom right corner of your video. And then click the red subscribe button that pops out. That will subscribe you to our channel. Click the thumbs up icon down below the video. That lets me know two things. You like today's video and you want us to keep doing it. A simple way to give us feedback there. Comment on anything that stands out to you from tonight's video. Join our Market Outlook daily email list. There's a link popping up in the top right corner of your screen. Click that link to join our list. Follow me on Twitter for more content like this throughout the day. And join our Market Outlook community on Facebook. All right, well, let's take a look, first of all, at the S&P 500 with the market forecast indicator. And you'll see that we continue to have a strong bullish posture with the intermediate line up there in the upper reversal zone. Again, it doesn't matter if it's going up, down, sideways. Doesn't matter. As long as it's higher in that reversal zone, strong bullish posture. And you see we've been bullish now for a month. The expectations is 2 to 3. We did get that overbought cluster right here early in that period, which is typically a good sign that we can last a little bit longer. So now we're heading past that 1 month time frame, heading into month number 2. So that's kind of the expectation. Now, absent seasonality, right? Typically, mid-August to late August is a weaker period for stocks. So absent that, just looking at the market forecast indicator, you can see we would expect bullishness for a little bit longer here. The near-term line has been above 50 now for, let's see here, this would be 1, 2, 3, 4, 5. 5 days that it's been above 50. So we expect 7 to 12. Now, the momentum line fell. It fell into the reversal zone. It did not fall to an extreme. So it only fell at 12.78 over here on the left. An extreme is getting down below 5. Above 90 is extreme to the upside. Below 5 is extreme to the downside. So it's oversold, but not to an extreme, which means with the combination of a strong bullish posture and an oversold short-term momentum line, that's a buy the dip kind of a bounce trade. Now, typically, it's better if the near-term line is also down to where it can set up a bullish low point too. And it's not quite, still up in the reversal zone. But it's also got a few days left that it can stay up there. So, there's a possibility. It's not the greatest buy the dip signal, but it is a buy the dip signal nonetheless. And so that gives us an opportunity, the expectation that despite today's, quote unquote weakness, that we'd expect to continue higher here over the next few days, possibly into the end of this week, before that seasonal weakness at least puts pressure, if not some headwinds, on stocks to keep it from going too much higher. You see we're already up to a higher near-term high point. We're obviously up to a higher intermediate high point, and market sentiment's in the upper reversal zone too, which is a positive development as well. The expectations there, on the orange line, being above 50 is 6 to 9 months. And now we are, a couple of months into that, heading into the August. So now, if for whatever reason we don't meet expectations on those time frames, if we come in a lot shorter, then that's a sign. That's a sign. In fact, I detailed in the, was in last night's class. Excuse me, I can't get this frog out of my throat. I compared the current market for this year to 1987 to see, okay, can we, how likely are we to repeat the historically historical big drops in the market on Black Monday especially. And we looked at the market forecast indicator to look for those signs, and the signs that things may have been more bearish than we expected. And the signs are when we don't meet these expected runs. And right now, things are looking pretty good. They're looking pretty good from a near-term basis. The blue line, they're looking pretty good on the green line, and they're looking pretty good on the orange line as well. And remember, stocks move in the direction that causes the most pain. And I don't know about you all, but I see a lot of articles and a lot of posts about how bearish we are and how we have to turn down and how overvalued. And I agree with all of them. And the evidences are irrefutable how overbought we are and how overvalued we are. But that doesn't mean we have to immediately turn lower, because markets they're run by humans. They're not run by computers to where we reach a level and we drop immediately to get down to another level and then we just back and forth. They're run by humans, and humans can carry trends for long periods of time. It's a psychological element, and that's what's in play. And until we see otherwise, we continue to trade the trend and price according to the expectations with indicators like the market forecast here. We'll take a look here at the Dow Jones Industrial Average, same signal. It's what's called a bullish intermediate confirmation signal when you have a strong bullish posture and an oversold momentum line. Again, not to an extreme, only down to 8.73. And you can see it's not that much of a dip to be buying anyway, because, look at that drop that we've had. And then finally, the NASDAQ composite, almost getting that signal, and its intermediate line getting above 80. So it dropped more than the Dow and the S&P. And now it's back up in that strong bullish posture area, and the Russell 2000, which has consolidated more than all of them with this symmetrical triangle, something that we highlighted today in my options inventory class today, the expectation of where this will go based on the symmetrical triangle and what kind of move we expect out of it. And you can see right now the posture is bullish, and that bullish posture is strengthening with the line pointed higher. The near-term line is setting up for a lower high point. So that's a little bit of a red flag. See, there's this is the prior near-term high with a peak above 50. See, that one didn't get above 50. So there's the prior near-term high point. There's the current one. So as of right now, that would be a lower near-term high on the index. And the near-term line is this. It really has only dipped its toe in the upper reversal zone. It hasn't really set itself up there like all the rest. So a little bit of a concern on small caps. We'll see. Again, things are turning lower in the short-term line. It's got to get below 50 before we really say, okay, it's more bearish than what the posture is suggesting. Until then, as you can see a couple days ago, it can turn right back up that quickly with a good up day, which, according to the trend of the intermediate line, is what we would expect to see. All right, as always, before we look at other charts here, our daily reminder that you can watch the market outlook on our blog on marketscholars.com. Just go to marketscholars.com, click on blog up here at the top. Usually you'll see the current market outlook listed at the top of the page. Just click on that, and this is where you can watch the video. Now, right now, while you're watching, if you want us to do this video again, if you want us to keep doing these videos, we need to hear from you. Otherwise, that's the way that we get feedback. And so we ask for 3 clicks for you to tell us, let's do the video again tomorrow. And that is right here. Click on the like button for tonight's Market Outlook tweet. It opens up a new window, and you can like it right there by clicking on that button. Also, click on this Market Outlook Facebook post. Click on that picture. It will take you to your Facebook page, and you can like it right here. And then finally, click on this like button right there. And that doing all 3 of those things gives us feedback, number 1. And number 2, promotes, or it's a way for you to tell Twitter and Facebook that this is good content that you feel like should be shared, at the very least, among all the people that follow us, as well as anybody else that likes this type of content. All right, back to the charts. You can see that we continue to grind our way higher. We've been up now 6 weeks in a row. This would be week number 6 that we've been up in a row on the S&P 500 on a weekly chart. You can see we're above a rising 50-day moving average. We're above a rising 200-day moving average. The gap between the two is rising. Again, I've mentioned this before. I'll say it again. That's about as bullish a long-term chart as you can have. And you can see it can stay this way for a while as it, we had, this is the intermediate run here that lasted 5+ months. You can tell the intermediate runs on this. Here's the first one, 2 and 3. Here's 2 and 3 in the middle there. You can see every time we start a new run, we come up off the 50-day moving average. And you can see that they can last for weeks, months, 1 to 3 months, right? That's 4 to 12 weeks that you can see here. And so far, we are 6 weeks into the current intermediate run. So if you look at the Heikin-Ashi candles, which smooths out so you don't get so many ups and downs, you can see how the intermediate runs, they just continue to push higher until we break through the low point of the prior week. Really is that significant turnaround. That's when you get a long lower shadow. You see that Heikin-Ashi candles typically don't give you a lower shadow. That means you have to break through the low point of the candle. And the low point of the candle is the midpoint of the prior week's body. So that's the midpoint. That's the low. So it's different than a typical open, high, low, and close. That's the open. The open of the candle is the midpoint of last week's range, and you can see that going forward here. So to produce so it's not necessarily the actual open of this week. It's that midpoint of last week's range. So to produce a lower shadow on this weekly chart, you have to get below. Sometime during the week, we have to get below the midpoint of last week's range. And again, that doesn't happen. And sometimes it did. It did last week, just a smidgen. But when you get those significant lower shadows, that tends to be the turnaround. And of course, we're not anywhere close to that. That's for SPX. The open of this candle is 28.11. So that kind of gives you an idea. And on SPY, the equivalent for SPY, you can see is right here. It would be 280.67. Now we take a look at the 3 green arrow charts. Again, we still have 3 green arrows. So we're shaded green on this chart again, bullish from that perspective. You can see we're losing a little bit of positive momentum. That histogram is not getting nearly as high. If you take a look at the actual MACD lines, you can see why the histogram is not getting so high, because that's the problem with looking for divergences in the histogram. Well, there's a reason why the histogram is not getting very high. It's because the orange line, see, the histogram measures the gap between the blue and the orange lines here. The blue line being the actual MACD line, and the orange being the moving average, the smooth MACD line, or the in this case 9-day simple moving average of the MACD. And so because it's already relatively high, you're not going to get a big histogram on this. But you are still up above an 8-day moving average, obviously still well above a 17-day moving average, and both lines easily above a rising 6-week or 30-day moving average. So bullish across the board. I'm not as bullish as we could be when we're coming up off a low point, obviously, but we're still continuing to trend and push and grind our way higher in the path of what causes the most pain, which for a lot of people right now who think that the market should be dropping, we'll just continue to grind away against those sentiments. All right, if you take a look now at the SPY, and you can see we didn't quite get a new all-time high, we didn't get a new all-time high. We also didn't get a new 4-week high point today. We pulled back here at the very, very end, the 285.46. You can see in the after hours here that we're continuing to pull back a little bit more in the after hours down to 285.11. So that would put you just a smidgen right down closer to today's low point. Today's range was really, really small, a little bit bigger than it was yesterday. Yesterday's range was really small, but a new 4-week high point yesterday. And eventually, see, this is going to move up tomorrow to that low point, and then it's going to move up again to there. And as these lines move up, so will the blue line. And you remember the key number to look for a turnaround on a long-term basis is 280.67. That's the midpoint of last week's range. And you can see nowhere close. It was a 281.67, I believe. Yeah, right in this area. There's the midpoint of last week's range. No, excuse me, it's 280.67. It was the midpoint. It's the midpoint of the body. So the open here, 280.67. That's the key for the turnaround that we're looking for on a long-term basis. So that's way down here. So again, when you start seeing possibilities of a long-term turnaround, then we have to start forming that long lower shadow on that Heikin-Ashi candle on the weekly chart. And to even form a smidgen of a long lower shadow, it's got to get below that level where my cursor is right now. So that kind of gives you an idea. We're not anywhere close to, a falling off the cliff or it's any kind of correction. We might get a little near-term pullback here or there, but as of right now, even the short-term chart here shows, again, just how bullish we are. And of course, you look at the range you saw was really, really small, and then the volume at 42 million. So small ranges, small volumes, that will pull both of these lines down, 42 million being well below the average here, 20-day average, and even below the 52-week low point for that average, the low of the year range, 1 year range. And then today's range here was not 0.97 points. I mean, that's way down here. And that's still, there's still room for this purple line, which is the absolute ATR, to continue to fall. And as it falls, that's bullish. And you can see it can stay down for a long time. I've been getting questions about, the volume being so low. Is that a bad thing? Remember, volumes stay low when the market trends higher. And you can see a good example of that last fall. It can stay low and that it will start to move up. See how volume started to move up here as the stocks moved up. And then, the volume, even it was a lot higher up here. By this day, you can see how the average volume was at 89 million. I'm looking at that number right there. The average volume was at 89 million compared to back here when the average volume was at 54 million, 55 million. So you can see it's usually when volume starts to rise along with a rising trend, a bullish posture. That's when it's okay, we might get some more of an intermediate term pullback. And obviously, we're not there yet either. Finally, we'll take a look at the VIX. It's very low on an absolute basis, and of course, on the relative basis, extremely low. We talked about what that means and how to deal with that today. In that options inventory class. So extreme lows in the volatility. And as I have mentioned before on this video, that doesn't mean it has to bounce up. Usually it does. But as we learned last year, so I have to go back a couple of years now on this. But as we learned last year, we can stay low for a long, long time. And again, that was just last fall, a similar time frame that we're heading into right now. Okay, so now I want your vote. Do you agree or disagree? Click that link that just popped out in the top right corner of your screen on the video, and then click on the poll. Agree or disagree with the current market posture that continues to be bullish, and with everything that I've shown you on these charts. If you disagree, no love lost, right? Different opinions make up a market. Love to hear, though, what it is about what you're seeing that makes you more bearish, or maybe makes you even more bullish than we are on the chart. So let me know down in the comment section down below. All right, now let's talk about what's driving the price action. I tweeted out earlier today whether today was a risk on or risk off move, and we were actually started the day lower, and it did not look very risk off. If you take a look here at this chart, though, it actually does look like a risk off kind of a day. You can see crude oil inventories was really the only major thing on the calendar, and that prompted a drop in crude oil of 3%. Look over here on the bottom right at the big decline. You can see it's rolling over. The moving average here rolling over. The intermediate line is falling at low levels. getting to be a pretty strong bearish posture on crude oil. Obviously, the strong dollar is helping that with a strong bullish posture and rising moving average. Same, also putting pressure on gold. But you see, not today. Gold, TLT, intermediate bonds. Here's the long-term bonds. Here's the intermediate. So it's more like the 10-year. There's growth stocks, mortgage-backed securities, municipal bonds, short-term bonds, and inflation-protected securities. Excuse me. All of these. Those are bonds and gold. And there's global bonds. Those are all kind of risk-off type moves. Now, they're all on bearish trends. You can see the moving averages are falling for all of these, except for the corporate high yield, which has got that strong bullish posture. All the rest of these have either weak bullish postures or strong bearish. So when you're looking at bonds, we're not in a risk-on type of environment at all. Corporate, you can see MLPs are showing strong trends, even with the weakness recently in crude oil. Dividend stocks are showing a strong bullish trend. Preferred stocks are kind of flatlining here, even with the weakness in bonds. And then there's real estate stocks, strong bullish trend. A little bit of a pullback right now, but strong bullish trends. But today, small cap stocks were down, not very much. Mid cap stocks were down, so pretty broad selling at a really, really low level. There's your S&P 500. International stocks also declined, even with a little bit of a drop in the dollar. So that didn't really help. So, on one level, it was a little bit of a risk-off day. If you do take a look at the foreign markets here, and we'll pull up that chart, you can see the S&P 500, while it was down just a smidge, it was still one of the better performing. Canada still continues to do well. Had a big decline yesterday, so a little bit of a bounce up today. India, it's one of the strongest trends that we have. You can see it's got a 95 figure on its intermediate line. Only the S&P 500 shows as strong a level. Brazil is pulling back, still down 10% for the 3-month period. And of course, Canada pulling back too, but they're pulling back above 80, so they're still showing strong bullish postures here. And those are really the only four that are showing strong bullish postures. On the other end of the spectrum, look at Russia declining sharply today, down 4%. China still continuing to underperform. France, Germany, Italy, all these European countries here. There's Germany, there's France, there's Italy. They're all pretty flat. So, considering that they've been strongly bearish for a while, the fact that they're at the least flattening out is positive for these European countries. You can also see China is trying to develop a base too. It's not flattening yet. France actually has a green moving average. So does Germany, and so does Italy. So that's how flat they are. The fact that they were red and now they've turned green just by a little bit, whereas we're still yellow to red on China and on Korea, these Asian countries that have been, all of these really impacted the most negatively by the trade wars. There wasn't a lot on the calendar that impacts. We had the petroleum report. That was really the only thing on the calendar. Tomorrow, you'll start to see some inflation data. Thursday, we'll have the PPI. Friday, you'll have the CPI. That will impact rate hike odds, which are rising for that December. Remember, the next meeting in September, we're more than likely going to get that next rate hike on September the 26th. But December 19th, that's the next one in question, and it's looking increasingly likely that we'll get another one there. Now, of course, there will be a press conference in January. So the odds aren't rising yet for a kind of a break of this quarterly rate hike. You can see that would be the 250, 275. It's rising a little bit there, but still high odds that we'll get, one more after September, which is like 95% odds, that we'll get one more rate hike somewhere in here, most likely in December or January. And then in March, that's when you say, okay, well, we're going to get that next rate hike up to 2.5%, that 250 to 275 basis point mark here. There we go, that dark blue, and you can see it's starting to rise. It's still below 40%, so it's not very high, and the odds of getting another one, is down here, this yellow line. So we're looking at maybe 40% odds of that successive rate hike. So it's not. So here it is in March, 40. What is it? 40. You add these two numbers here, about 40%, about 41% odds. So not very high yet. But tomorrow's calendar, these next two items, will go a long way to raising these odds or not, right? Depending upon how inflationary we see things. Of course, this one, this will be updated tomorrow too. This is the GDP estimates. Currently at 4.4%. They have been up to 5%, one of the most recent revisions. So we'll see if it starts to pull back towards the blue chip consensus here. So from an asset standpoint, while it may have looked a little risk off with bonds rising, stocks falling, in the U.S. stock market, it did not look risk off. In fact, here's your performance in the S&P 500. Your four sectors that outperformed. Here, let me bring up the sectors chart over here. The four sectors outperformed: technology, financials, and discretionary. With a rising dollar, that's what you'd expect to be above the S&P 500. Now, they're not like going crazy, but they're also not leading to the downside either. Of course, energy struggling with the drop in crude oil today. But look, you have utilities, real estate, and staples all pulling up the rear. Now you also have materials and industrials. Those are tariff-related items, but you also have these interest rate sensitive sectors that really lagged the market today on a day where bonds are not up that much. The yields were not down that much. So, again, not your typical risk off kind of a day. So, put that in perspective. When we're as bullish, we may feel like we may be more bearish than what the charts are showing. It's not showing up in the sector rotation right now. You can see which ones, there's your utilities, real estate, and staples down here at the bottom. Staples, pulling back over the last few days. Simply just a pullback. It's still got a strong bullish posture and above a rising moving average. Utilities also pulling back, in real estate. So we're all kind of giving back some of their recent gains. Healthcare is still holding up strong above that. It's got the strongest intermediate line out of all of them. Very strong trend. Supposed to be an announcement next week from the administration regarding drug prices. So that's a sector to keep an eye on. See if the market starts to sell off these gains ahead of that expected announcement. But you can see technology, financials, and discretionary, three bullish sectors outperforming the market today, all above rising moving averages. The only one that's really kind of struggling to keep up the pace is energy and materials too. And you won't see these two areas take off until the dollar drops. As long as the dollar keeps going higher, they will put pressure on these two areas. So not a whole lot of bullishness to do right now, sticking more towards your typical leadership as well as healthcare and financials. You can see industrials have been showing some strength, but as long as tariffs are in the headlines, that's going to be a volatile sector to be involved with. All right, so lately I've been showing you some bullish trades in the healthcare sector because of how bullish it's been. Not everything has been, trending significantly higher. One stock in that area, AbbVie, you can see yesterday broke down and closed below the low of the high day with a pretty strong move, and now continuing lower today and kind of setting some resistance up here in this area. You can see that's what the three green arrows looks like. When you break that down and look at the different lines here, you can see that we have been consolidating. The MACD and stochastics are both turning lower, moving towards their moving averages, coming down from what would be a lower high point than the last peak on both of these indicators that we had. And you can see the moving average has got above the 30-day moving average, but it doesn't look like they're going to be able to hold, at least as of right now, with that long candle that we had yesterday. You look at the market forecast for AbbVie, and you can see that the short-term sentiment dropped sharply yesterday. The it got close to the 5th percentile. The near-term line after this divergence, see how we had this lower highs on the blue line with higher highs on the chart. The target for the divergence would be down here, this 89 level, the low point in between those two highs, with the near-term line falling and the intermediate line potentially falling from below 80. That's what happened here when we had that low point. Pretty bearish move for this stock. And like I said, it's a strong sector that has some headline risk coming up in there. So, we have some bullish trades in the sector. On one of them, in Mylan, had the negative earnings that brought it down. It was a long vertical spread that we did on Mylan. That now has been closed out for the loss that we had there. Remember, we had a decent profit-loss ratio on that stock. Well, here's another opportunity to balance the risks in that sector that is strongly bullish, but may be getting long in the tooth. And a stock, in this case, that has not been participating in that strong bullish trend. You can also see, too, like from some of these other lines, like the Bollinger Bands. We hit off of the top band, or came close to the top band, and now we're back trading potentially below this 50 level, which would be bearish. You can see you get below the 50 line, that starts to trend our way lower, especially coming from above 50 and making our way back down. Again, similar to what we did over here, and coming after earnings. We don't have earnings now until post-October expiration. So an easy way that manages the risk a little bit better to do a bearish trade on AbbVie, as you can see it set up here, is to go out to that 44-day window, selling the 30 delta, which would be the 97.5, the 130, 138, and then buying the 100 for protection to the upside. If it breaks above those highs at 100, then we can manage the loss potential. $2.50 wide spread, we're getting about 58 cents, a little bit less than what we were getting earlier when I was looking at this trade. But you can see if I analyze this, 2 cents less. If I analyze this trade, the break even, high probability, almost 74% odds of making something. Now, if you're going to make something, it's most likely going to be maximum gain. There's not very much room to make something that's not maximum gain. That's what that level. So we're either going to get maximum gain or we're probably going to get maximum loss. Now, if it starts to break up, then we're going to close out right there with about a $60 loss. So that's going to be above. In fact, you'll see that there's the break-even line. It's going to be right above that high point. So if we get above that high point, we'll take a small loss on the trade. It didn't work out. We're planning on that since it's closed below 2 days, the last 2 days there, that's a kind of a bearish reversal sign. That we don't have to, it doesn't have to drop, it just has to stay below that high point by September expiration. You can see, there's some significant resistance here with the volume in this area right about 98.35. So that's why we hit it and fell off so sharply, because that's where most of the volume has been this year. At a price level, that's where most of the volume has been this year, and it's going to take a breakout move to get through that area. Now, if it gets through that area, you've got some room to run, but it's most likely going to stay in this area with this kind of being the low point, so kind of a sideways range here, where my cursor is about 89. As long as it stays below there, then 97.5 is the strike, so it can stay anywhere in this area, and we notice our gain is going to be the same regardless. Not today, but by expiration. All right, so now I want to hear what you have to say. So click on the link popping out in the top right corner of your video. That will take you to our Market Outlook forums on marketscholars.com. Comment whatever questions you have on tonight's video, on today's trade idea, today's market posture, on any of the charts we're looking at, on any charts I didn't look at. Post your questions and comments there in the forums. Thank you very much for watching tonight. Remember to subscribe to our YouTube channel. Click the thumbs up icon down below the video to let us know that you want us to keep doing them. And of course, comment. Follow me on Twitter for more content like this, and join our Market Outlook community on Facebook. Thanks again. Have a great evening, and we'll see you all next time.